Hi, I'm Steve Breen with Prosperion Financial Advisors. We create and communicate Prosperion videos to deliver timeless, valuable wisdom for our clients, with the hope of providing greater clarity, capability, and confidence to them. In other words, we want to help you become better investors. We hope that these are valuable for you as well as your family. By now, most of you have heard us preaching the gospel of our growing dividend strategy. At the very core of our investment philosophy is the notion that our clients invest for income. That's income either for today or income for the future. But the crux is almost always income. Well, a focus on income invites unique challenges as well as opportunities. For instance, the largest challenge is a continually growing income stream that outpaces the inflation rate. Inflation is that constant hill that always needs to be climbed. Without growing income, the purchasing power of your money will decrease over time, along with your standard of living. That lack of growing income has the effect of clients getting poor slowly. You don't notice it on your monthly statement or your annual net worth, but when you're at the grocery store or at the kitchen table, you just realize that your money doesn't go as far as it used to. Inflation is kind of like cancer. It shows up at the most unexpected places, the most unexpected times, unannounced, unwelcome, and you feel it. Fortunately, we believe we have found a method, an investment strategy that's designed to overcome that obstacle, one that doesn't involve drawing down your portfolio at an ever-increasing rate, one that doesn't involve selling assets at the wrong time. Our method relies on a simple structure, investing in a very common investment, solid companies with a history of growing their dividends at a rate of 7 to 10% per year. That's why we stress to our clients that they can express this investment strategy in 3 simple sentences. Number 1, we only invest in companies that sell essential products and services that people buy every day. Number 2, these are companies that currently make a nice profit and share a portion of that profit with the shareholder owners in the form of a dividend. And number 3 is that the dividends historically have increased at a rate on average of 7 to 10% per year, generally over a 5 to 10 year period. Compare this with more exotic financial plans that are offered in the sea of sameness by large investment brokers, insurance companies, banks, etc. This strategy is surprisingly simple, but it helps us to accomplish that goal of long-term rising income. Clients are free to spend that income that's generated from their portfolio without touching the principal or depleting it by a certain percentage each year. This is fundamentally different from the approach that most people in the financial services industry advise. A picture tells 1,000 stories. Here's a revealing chart that's provided by Morningstar, FactSet, and Barclays. The chart illustrates the income that's generated from a $10,000 hypothetical investment over a 37-year time frame. Why 37 years? Well, think about how long retirement lasts. Don't you want your money to last as long as you're retired? Statistically speaking, a couple who retires at age 60 is more than likely that one of the two will live into their mid-90s. Your money and purchasing power needs to keep you covered for a long period of time. You don't want your money to run out before you do. That's an unpleasant thought. Well, this chart, if you notice the bar illustrates the income from the bond market. That's illustrated from the red bars, which are really the Barclays Aggregate Bond Index, something that's well accepted by most financial services providers. Interestingly, income starts out higher from the bond investment at around $745. But as interest rates have fluctuated dramatically over this time frame, that income has decreased to $275. Conversely, notice the income from dividends that starts out at about $460 steadily increases over this time frame, ending up around $4,000, an increase of tenfold. Now that's growing income. What's also interesting is that bond prices tend to be steady, but the income from bonds fluctuates dramatically. Conversely, stock prices fluctuate, but the income increases steadily. You can't have both. Which would you rather have, rising income or steady prices? Dividends are not guaranteed, but then neither is the interest from a bond. And really, the security from either interest or dividends depends entirely on the quality of the bonds or the quality of stocks that you invest in. Of particular interest, but really not noted in this chart, inflation was up over this time period only fourfold. Our point is this: without growing income surpassing the inflation rate, investors are slowly and quietly losing purchasing power until it's too late. In the entire spectrum of financial assets, I believe there's only one that's demonstrated an income that, at least since 1926, has never failed to increase at a rate greater than the inflation rate over a 30-year time period. That's why we place such an emphasis on constantly rising dividends with great companies in America and around the world. In the past, investors and advisors have been way too focused on current income, and I believe that methodology and strategy has its drawbacks and will be especially telling for prospective investors today. Well, if you'd like to have a conversation about the concept of growing income with our growth of dividend strategy, feel free to let us know. Thank you for being a client of Prosperion Financial Advisors. I'm Steve Breen.